Welcome to this explainer. Today, we're tearing into a $4 billion regional bank stock that has Wall Street completely split down the middle. We're talking about Renasant Corporation, ticker symbol RNST. On one hand, you've got explosive earnings growth that looks absolutely incredible on paper. But on the other hand, you're looking at severe price underperformance and some pretty glaring quality concerns. So let's unpack exactly what's going on beneath the surface and figure out what this all means for your portfolio. We've got a lot of ground to cover today. We're going to look at 7 hidden red flags, flip the script to look at 7 overlooked green flags, run this through the ultimate guru framework test, and wrap it up with our final verdict. Let's get right into it. Right out of the gate, the gravity of the situation really hits you. Renasant is sitting on a staggering drop of nearly 23% year to date. That severely underperforms the broader market, especially when you consider the S&P 500 has been putting up double-digit gains over the same time period. The market is clearly pricing in some major risks here. But here's where the plot thickens. Despite cratering like that, they just posted a massive Q2 earnings beat. So we really have to ask ourselves a critical question. Is this thing just a toxic value trap waiting to spring? Or are we actually looking at a generational GARP, growth at a reasonable price opportunity? Section 1, 7 hidden red flags. These are the things the media probably isn't telling you. Starting with quality and valuation, Guru Focus gives them a pretty mediocre GF score, which measures overall fundamental strength, putting it somewhere in the 58 to 68 range out of 100. And honestly, it looks technically overvalued right now. With intrinsic GF value estimated up to about $37, trading at its current levels means it's roughly 14 to 31% overvalued. Oh, and sure, they beat on earnings, but their Q2 revenue of $273.9 million actually missed estimates by 2.3%. That definitely makes you question the quality of that revenue. And man, when you group together the market sentiment flags, the picture gets a lot darker. Insiders are bailing. We're talking over $2 million in open market sales over the last 6 months and practically zero buying. When executives like the CFO and vice chairman are dumping thousands of shares, you've got to pay attention, right? Throw an elevated short interest of nearly 5 million shares, plus analysts like Hovde Group slashing price targets to $37, and yeah, it's pretty clear why the stock is dragging. Section 2, 7 overlooked green flags and the hidden upside. But hold on, let's flip this around and look at the other side of the tug of war. So remember that Q2 earnings beat I just mentioned? Adjusted EPS didn't just barely edge past estimates. It absolutely skyrocketed by 36% year over year, hitting 94 cents a share. Plus, they slashed their efficiency ratio from 65.5 down to 55.7%. That is just proving they have some incredibly strong operational leverage working for them. Now, when you look at traditional valuation metrics, things get really interesting. Renasant trades at a trailing PE of just 12.5 and a forward PE of an absurdly cheap 10.4. And that PEG ratio, it's sitting at 0.70. That is absolute music to a value investor's ears. Combine that with a fortress balance sheet holding $906 million in cash, and it completely explains why heavyweights like Vanguard and BlackRock own massive stakes here. You've got serious institutional price support. Section 3, the Guru Framework Test, judging the fundamentals. With 14 completely conflicting flags on the table, it's time for the ultimate showdown using 4 legendary investor frameworks. First up, moat analysis. Do they have a durable competitive advantage? Well, they operate as a regional bank in the Southeast. Sure, they benefit from customer switching costs and a sticky deposit base, but let's be real. Banking is a heavily regulated, hyper-competitive commodity business. They just don't have the massive scale or proprietary tech of the megabanks. So the verdict? A narrow to basically non-existent economic moat. They have some protection, but very limited pricing power. Next, we bring in the father of value investing himself, Benjamin Graham. And under his strict criteria, RNST actually passes 6 out of 7 tests. The PE is way under his 15x limit, price to book is right at 1, and the earnings yield is a super healthy 8%. So why is it only a borderline buy? Well, it trades at roughly a 15% premium to its Graham number, which sits around $36. Graham was notoriously conservative, so that slight premium holds it back from being an aggressive buy, but it is very, very close. Now, if you follow Peter Lynch, you are probably salivating right now. The guy loved growth at a reasonable price. With that PEG ratio at 0.70, which is way under his golden rule of 1.0, and earnings growth completely dusting its PE ratio, this is a textbook GARP play. The business is simple to understand, free cash flow is positive, and debt is low. Lynch would absolutely be an aggressive buyer here. But what about the Oracle of Omaha? Well, Warren Buffett would probably take a pass. Why? Because even though the valuation is cheap, the return on equity is only 8.21%. That is way below Buffett's strict 15% requirement for a wonderful business. It passes his test for strong operating margins and being a simple business, sure, but it lacks that durable competitive advantage. Remember his famous rule: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Renasant is a decent company at a really cheap price, which makes it a mixed signal for the Buffett crowd. So look at where this leaves us. We have a totally divided jury. The Mode Analysis and Buffett are waving yellow flags over quality and ROE. Graham leans positive, but wants a slightly cheaper price point. And Peter Lynch? His framework is just screaming buy based on that wildly cheap growth. Section 4, the final verdict. To buy or not to buy. Let's bring all this data together for the ultimate conclusion. The whole paradox of Renasant really boils down to this. In one corner, you've got this absurdly cheap regional bank with explosive earnings growth, a literal dream for a value growth investor. But in the other corner, you have to stomach below-average quality metrics, heavy market skepticism, and executives actively dumping their own shares. It is a classic heavyweight bout between pure momentum and underlying fundamentals. So what's the play? Well, keeping it on your watch list and maybe accumulating if it dips back into the $37 to $40 range might be the smart move. But honestly, your next step hinges on one critical question. As an investor, do you prioritize cheap, explosive growth like Peter Lynch, or do you hold out for undeniable high ROE quality like Warren Buffett? How you answer that tells you exactly what to do with Renasant Corporation. Thanks for tuning into this explainer, and keep learning.